We have the latest domestic unemployment and wage growth numbers on Tuesday the 11th of June as the main piece of macroeconomic news from this side of the pond in the coming week. While it's the inflation figures due on Wednesday the 12th that'll command attention in America. Remember that in the 3 months to March, the UK unemployment rate was 3.8%, the lowest number in 45 years. The employment rate was 76.1%, the highest figure since records began in the early 1970s, and wage growth including bonuses reached 3.2%. Now that pleasingly outpaced the latest inflation figure of 1.9% as per the Consumer Price Index. Over in America, inflation, again using the Consumer Price Index, was 2% exactly in April. That's bang on the US Federal Reserve's target. Wage growth is running hotter than that, but the American Central Bank is still maintaining its stance that it will be patient when it comes to any more interest rate increases. We've had 9 1/4 point hikes since late 2015. We can see the US inflation rate against the Fed's headline interest rate here. If anything, the US Central Bank seems more worried about global growth than it does of inflation, and it seems as open to cutting rates as it is to hiking them. As we flagged before, the CME FedWatch tool, which you can follow for free on the internet, is pricing in a 90% chance of at least one rate cut in America in 2019 and a near 60% chance of at least 2. This seems remarkable given low unemployment and gathering wage growth, so we'll see whether that forecast is accurate or just a product of wishful thinking. Company-wise, 8 FTSE 100 firms are due to release an update, issue results or host their annual general meeting, and some interesting mid and small caps will be getting in on the act as well. Potentially informative names to note are plumbers merchant Ferguson and British Airways owner International Consolidated Airlines on Monday the 10th of June, retailer Quiz and house builders Bellway and Crest Nicholson on the 11th, British American Tobacco and online retailer of fast fashion Boohoo on the 12th, and packaging player DS Smith, grocery giants Morrison and Tesco's, and the soon-to-be renamed Majestic Wine on Thursday the 13th. But for me, the stock most likely to cause a big fuss in the week ahead is Halma, when the FTSE 100 company publishes its full year results on Tuesday the 11th of June. As we can see here, the shares have had a good run in the past 12 months, even as the FTSE 100's fallen by around 7%. So good in fact that Halma stands at pretty much an all-time high. Now the company provides a solution to a problem in that its hazard detection and life protection systems, locks and devices help companies meet regulatory requirements and keep staff, clients and customers safe. The mandatory nature of this investment in this area creates consistent business flows and sticky customers, a combination which gives Halma a degree of pricing power. That in turn can mean high margins, good returns on capital, strong free cash flow and a growing dividend for investors over the long term. And it's Halma's dividend track record which could again cause a fuss this week. The analyst's consensus forecast is for a full year payout of 15.89 pence per share, an increase of 8% on the distribution for the year to March 2018. If that forecast is met, that will be Halma's 40th consecutive increase in its annual dividend of 5% or more. Now, on a share price north of £18, that still means the yield is going to be around 0.8% historic. May not thrill income hunters, but bear in mind that 10 years ago the dividend was 8.5p a share, and it's nearly doubled since. Moreover, 10 years ago Halma's share price was 164p, so what would you have thought then if somebody told you that 10 years later the dividend would be 15.89p for an implied yield in a decade's time of 9.6%? I think you might have been a bit more interested. Now, dear viewers, this is not investment advice with regard to Halma. Please, no, it's not. But it does show the power of dividend growth in general when it comes to capital returns as well as income when things go well. Now, you will now need to look at Halma's earnings cover for the dividend, cash flow and balance sheet as well as its trading prospects before you can decide whether that 40-year streak can run for another 5, 10 years or more. Be up to you to choose that. At first glance, earnings cover looks healthy enough at more than 3 times based upon the consensus forecast of 50.7p in earnings per share compared to that dividend estimate of 15.89p. This chart here shows the historic earnings per share, or EPS progression, and dividend cover for the last decade, along with forecasts for the year just finished and the year just begun. Besides the dividend and the earnings per share numbers, analysts will be looking at the headline sales, operating margin and pre-tax profit numbers. On a headline basis, the consensus sales forecast is £1.2 billion, an increase of 13%. The organic rate of growth may be of more interest, and at the first half stage that was 14% on a constant currency basis. When it comes to the operating margin, Halma's management team has a target of between 18 and 22% on an adjusted basis. At the first half stage, the operating return on sales was 20.1%, slap in the middle. And for pre-tax profit, the consensus estimate is £244 million against £194 million a year ago on an adjusted basis. For the year just begun, consensus is looking for another 10% increase to £268 million. More strategically, watch out for updates on acquisitions, as Halma uses select purchases to supplement its organic progress. At the first half stage, Halma had snapped up 5 firms, including Limotech and Navtech, as part of management's plan to double the company in size every 5 years or so, and it's announced one deal since, the Wisconsin-based emergency communications company RAF for £33 million. Thank you for watching, and I look forward to seeing you next time.